Hi, how's it going everyone? My name is Henk and welcome back to the channel. Now in this video I'll be talking about the recent Chinese stock market crash, including what happened there and whether or not it is a good buying opportunity for you. You know what Warren Buffett always says, be greedy when others are fearful and be fearful when others are greedy. So recently, Chinese regulators have started to heavily crack down on companies in many different sectors. The first sector that they targeted are the big Chinese tech companies, such as Alibaba and Tencent, over their monopoly practices. Now, Alibaba is basically the Chinese equivalent of Amazon in the US, and they run the biggest e-commerce platform in China, bringing in billions of dollars per year. Now, back in April, Alibaba was fined $2.8 billion by Chinese regulators for anti-competitive practices, because they said that Alibaba pressured the sellers on their platform to sell only on their platform exclusively. $2.8 billion seems like an astronomical amount for most people, but it's only about 4% of their domestic and not even counting their international sales on their platform. Within the last few days, the share price of Alibaba is down by more than 18% and almost down 40% from their February highs. A social media giant Tencent, who owned the biggest communication app in China, WeChat, have also been affected. Now, they are like the Facebook and WhatsApp equivalent in China. Now, in addition to that, they also the world's largest online game developer that owns multiple studios such as Riot Games, the studio that develops League of Legends, and New Zealand-based Grinding Gear Games and many other game studios. Tencent is also feeling the pressure from the regulators, with their share price down by 14% over the past couple of days, and overall they're down by 40% from their February highs. In addition to those two companies, WeiBo, which many people have compared them as the Twitter of China, and JD.com, another big Chinese online e-commerce platform, have also felt the pinch, with their share price down significantly. The second area that regulators crack down on are companies that may pose cybersecurity risk to China itself. Now, the main target here is the rideshare app DiDi, which can be seen as a Chinese equivalent to Uber. Regulators said that DiDi violated restriction on collection of personal data, and their IPO in the US posed a potential risk of data leak. So regulators stopped new members from signing up to the app and remove DiDi app from their app store. Now, DiDi stock prices have fallen by about 50% since their IPO at the end of June. The third area that regulators cracked down on were the after-school tutoring sector. Now, getting into a good college or university in China is highly competitive, and many students go for after-school tutoring. And therefore, education, especially the after-school education, is a huge booming industry in China. Now, regulators have considered making after-school tutoring a non-profit business to decrease the overall cost of education on many Chinese families. Now, this sent the stocks of these tutoring companies crashing down, with some losing more than 90% of their value. Now, here's the thing that you might have to consider. What they're actually doing here are all actually really good things. They're essentially stopping big tech monopoly, restricting the collection of personal information, and making education cheaper for families. Now, what's very interesting is that in Western countries, there's also big concerns of big tech companies such as Amazon, Facebook, and Google basically controlling everything. Now, Amazon has long been pushing out smaller retailers, while Facebook is trying hard to hoard all the main social media platforms. And Google tends to favor certain search results. For the longest period of time, people have been aware of these things happening, but the government seemed to be able to do anything to stop them. So the question here is, if you care about monopoly, personal privacy, and cheaper living, would you live in a country like China? Or, I mean, it doesn't have to be China, but some hypothetical country where the government would heavily regulate these countries, or be in a Western country where you have more freedom, but big companies may potentially take advantage of it. See, I find there's always trade-offs in this world. You can't have all the freedom that you want without any sort of sacrifice. Okay, so should you invest in these Chinese stocks? Now, before I continue, I need to mention again that I am not a financial advisor, and these are just some personal opinions on these companies. Now, personally, I am a strong believer in Alibaba. So Alibaba is still China's #1 e-commerce platform, and that's not going to change anytime soon, just because they're being hit with these regulations. So in a statement by the company when they were handed the record-setting fines, they said that they will fully comply with the fines and the regulation moving forward. I am also a big believer in Tencent. The company covers two of the fastest growing areas currently, which are social media and online gaming. So even if they are hit by regulations, they are also not going away anytime soon. So for these two companies, their fundamentals have not really changed, and they're still expected to grow significantly over the coming years. On the other hand, I am not a fan of investing in rideshare companies, including DiDi or even Uber, because it's literally a race to the bottom in terms of their price. They're literally designed to pay the drivers as little as possible, so I'm not a fan of that particular business model. If we look at the Chinese education companies, they might lose up to 80% of their business if after-school tutoring does indeed become non-profit. So they are also too big of a risk, so I wouldn't really want to take a chance on them personally either. Now, one thing to note here is that Alibaba is listed on the New York Stock Exchange. So if you want to purchase shares from them, you can easily do so through all the international brokers currently available in New Zealand, which includes Sharesight, Hatch, Stake, Tiger Broker, and many others. There's a link to sign up to them down below. However, Tencent is not actually listed on the New York Stock Exchange. So of those four brokers, the only one that you can purchase them from is through Tiger Brokers. Now, if you think that you are not very familiar with these companies and you would rather invest in an ETF that invests in multiple companies to help you diversify your investment a little bit, here are three big Chinese ETFs that invest in these Chinese companies. The first one here is the iShares MSCI China ETF with the symbol MCHI. Which covers the total China market. Now, this one is the biggest and possibly the most diversified China ETF with almost $7 billion under their management. And they cover the entire Chinese market. The second ETF is the CraneShares China Internet ETF with the symbol KWEB. This ETF covers mostly the big internet tech giants like Alibaba, Tencent, JD, WeiBo, and others. This ETF was hit particularly hard by these recent regulations, but has the potential to bounce back the strongest. The third one is the iShares China Large Cap ETF with the symbol FXI. So this particular ETF covers the large cap companies in China, including the internet companies and many of the big financial institutions there. So overall, this is not the first time that Chinese companies have been hit with regulations from the government, and certainly it won't be the last time. Now, Alibaba's sister company and corporation was supposed to have one of the biggest IPO in history last year, but it had its IPO cancelled due to pressure from the Chinese government. Now, Tencent was threatened to have mobile gaming removed by the government a few months back, but ultimately both companies bounced back. Just as a side note, all of the Chinese stocks that I mentioned before had a significant rebound during the most recent trading day. But expect volatility to continue for the upcoming week or so at least. Personally, I think some of these Chinese stocks present a great buying opportunity, but be sure to do your own due diligence before buying anything, and I will see you in the next video, and keep hustling.